Hi, I'm James Robinson, and this is my stock pick of the week. So this stock pick of the week is a special situation and it's pretty time sensitive. My pick of the week this week is MSC Industrial Supply Company, symbol MSM. You may remember that back in August I told you to buy this stock and I haven't yet told you to sell it. So you'll probably be curious to know why I'm suggesting you might want to buy more right now. I'm not sure why exactly MSC Industrial Supply is symbol MSM, but I'm going to refer to it as MSM for the rest of this video. I did a series of videos on MSM back in August, and you can find them on YouTube, you can find them on my page, and you might want to go back and watch those just to get a sense for why I like the company, what the company does. I'm not going to get into all that now because it's not really that germane. So here you can see my ranking of MSM in the 29 categories that I look at for the company. You can see that it has a grade of 3.03, which is the 81st out of the then 883 companies that I had looked at. So it's a very, very solid company, and there's no reason why I wouldn't advise you to buy this company ordinarily, but today there's some special reasons why I think you should consider buying it. So just to recap, on August 12th, I said you should buy the stock at $67.99. The good news is that today the stock trades at $75.59. So the stock is up, including dividends, about 10% in 5 or 6 months. On December 17th, however, the company announced a dividend of 75 cents per share. So basically a 1% dividend, and that's in line with expectations. That's what they've been paying in terms of dividends. However, the company also made a major surprise and is also paying a one-time special dividend of $5 per share. So you get paid both dividends, $5.75, if you own the stock on January 21. So in one day, you'd get a yield of 7.6%. Of course, that's not exactly how it works. So when I say that's not exactly how it works, I've long been fascinated by one of the traditions in the stock market. And today I believe that fascination and sort of thinking through that issue is going to pay off for us. So here's the situation. When a company goes ex-dividend, which means the day after the dividend is paid, the price of the stock typically drops by the amount of the dividend. So using easy math, if a $100 stock pays a 1% dividend, then the next day the stock typically opens up at $99 per share. So why does this happen and how does it affect us and what do I find so fascinating about it? So in my research, really as far as I can tell, the logic for why this happens is twofold. First, it is fair to argue that from an accounting standpoint, the company is reduced in value by the amount of the dividend. So if a company has a value, and we'll call the value the market cap, of $100 million, and they pay $1 million to shareholders, well then it's fair to argue the company should be worth $1 million less. So the company would now be worth $99 million. That certainly makes logical sense. So the ramification of that is that if the value of the stock should go down by an equal percentage. So again, the $1 stock, a $1 dividend or a $100 stock equals a $99 stock. Logically, from a bookkeeping perspective, that does make a certain amount of sense and it's kind of obvious. The second reason why the stock would go down by the dividend amount is that the new stockholders, after the date that the company goes ex-dividend, are no longer eligible for that dividend, and so they have to wait for the next dividend to be announced. And it's that waiting which causes some reduction in the value of the stock. There's a time value money assessment, right? That $1 today a dollar 3 months from now is worth less than $1 today. And also there's an uncertainty factor. Will a dividend be paid 3 months from now, and how much will it be paid? It could go down, whereas the dividend that's currently in place is locked in because it's been announced. So those two factors, the idea that the book value of the company has certainly been reduced, should reduce the reduction in stock, and the fact that there's a income stream for the investor, which becomes either something you have to delay or becomes dubious. Those are the reasons why the stock price drops by the amount of the dividend. And so while all of that logically makes sense, it isn't actually the way the world works, and it doesn't really make sense to my way of thinking. So let me explain it. If a 1% reduction in if a 1% dividend resulted in a 1% reduction in the value of the stock, then that effectively is saying the value of the company is the book value of the company. Because when you reduce the book value by 1%, you get a 1% reduction of the value of the company. But that's not really the way it works. Companies are virtually never valued based on their book value. For example, MSC Industrial Supply trades at 2.75 times book value. So by using that logic, if we reduce the value of that stock by the 7.6% reduction in, by the 7.6% dividend yield, then that should mean that the value of the company should drop by 2.75 times the value of the cash they're expending, because they trade at 2.7 times book value. And that doesn't happen. And in fact, that would mean that every company should have a reduction in its stock price when a dividend is paid related to the price to book. And that's not the way it works. It's simply the value of the dividend. So the second thing to think about is that $1 million isn't really important to the investor. The investor cares about a whole bunch of different factors. The investor cares about, price to earnings. They care about debt. They care about growth. They care about all kinds of things. And they don't very often care about book value to the significant price that they'd significantly alter their opinion of the company based on book value. Not in most cases. Regarding the risk and time value money components, these aren't big components either. Nobody's buying a stock or adjusting the value of the price of the stock because there's a certain number of days before they get a dividend. That just makes no sense. And secondly, the yield that is being paid on these stocks on a quarterly basis is generally so small that it's an insignificant part of your analysis for the company. Secondly, if the risk that the next dividend either wouldn't be paid or would be smaller or would be larger were a significant factor in valuing companies, then the price, the amount that the impact dividend would have on echoing ex-dividend would have on stock price would be related to the strength of the company's dividend history, right? So a company that's been a dividend payer for 30 years and raises their dividends every year would have a different amount of adjustment when it goes ex-dividend than a company that's paying dividend for the first time. And that's not the way it works. It's pretty consistent. The dividend goes down by the amount, the stock price goes down by the amount of the dividend. So I don't believe that either of these two things really are an explanation for why the value of the company is reduced by the amount of the dividend. The price of the stock is reduced by the value of the dividend. I think it's just tradition, and I think it's a dumb tradition, and I don't think it makes any sense. So here's where all this leads me. MSM Industrial Supply is paying an enormous dividend of 7.6%. The stock price may and probably will drop the next day by that 7.6%. Fine. However, the value of the company is not derived to me by its book value. And to me, it's derived by its earnings, its future prospects. And I don't think any of that has changed between the day before and the day after the company goes ex-dividend. So to me, as an investor, the value of the company doesn't change at all. And what I would pay for this stock doesn't change at all. I believe that the company's future prospects remain equally strong. In fact, I would argue that they're stronger because the management has said, hey, things are great, we can afford to pay this dividend. So what my belief is that over the coming days and weeks, not months, but days and weeks, the stock will rebound back to its price. And when it does, so I'm going to buy it today at around $75.50 a share. I'm going to get my dividend when it gets paid, and then I will hold the stock until it recovers back to the purchase price of, let's call it $75.50. I'm not sure where it's going to open today. And then I'll sell my position. I'll take no capital gains through the sale because I'll sell it at the price I bought it. And again, I expect that recovery time to be measured in, a matter of weeks, probably less. So I will be investing my entire cash reserve in the stock, so roughly 15% of my portfolio. Remember that in the last video of my year-end report, I decided that I was going to run this more like a portfolio than just a stock picking. And I gave myself a nominal $150,000 portfolio, and of that about 15% of that was cash. So I'm going to be investing that entire cash portfolio, the entire cash balance into this. I already own some MSM, so combined my new purchase and my existing purchase, about 22% of my funds will be in MSN, which is by far my largest holding. I'm going to do this because I'm confident. I still believe the stock is undervalued. I still believe it's going to go up from here without this dividend issue. I believe the company is very conservatively run, and I believe they would not announce a special dividend if management didn't feel the company would continue to prosper. So I look at this dividend as an extremely good sign and a reason to feel confident. And again, because I don't think the company should be valued based on its book value, I think it should be based on its ability to generate earnings. I think those earnings are not in any way endangered by this dividend, and so I think this continues to be a great stock. Also, I don't mind holding the company if it takes a little longer because it pays a regular dividend of 4%, and that's better than I'd be getting if I had my money in cash. So even if it takes a few months for it to rebound, I'm comfortable that I'm not going to get killed because I think the company's going to do well, and because it's better to get a 4% dividend yield than zero yield, which is what I'm getting in cash. So my pick of the week this week is to load up on MSM Industrial Supply because that's what I'm doing.